Home sales just plunged in the month of January. And it's not just a seasonal dip. What's weird though is the mortgage rates aren't spiking right now. They've actually eased quite a bit since last year. So if affordability has improved even a little bit, why are buyers stepping back? Is this just a slow winter month? Or is it the first real sign that the housing market is starting to turn? And so in this video, I'm going to break down what actually happened in January and why sales fell even though rates have eased up a bit, and where we really are in the housing cycle heading into the spring. Because if the market is going to turn this year, this is exactly what it would start to look like. See, every housing cycle has the moment where something starts to feel off. It's not usually a dramatic feeling. It's not usually a dramatic headline. It's just a slight shift. Sales start to slip, homes sit a little longer on the market, and buyers start to move forward with more caution than ever. Because this wasn't just a normal winter slowdown. This was one of the biggest month-to-month drops we've seen in a while. And at the same time, prices haven't fallen. Sellers aren't panicking, and the broader economy hasn't crashed or anything. So we're in this weird middle ground right now. There's no booming housing market, and there's nothing crashing, just uncertainty. So let's dig into it now. So what actually happened last month? All right, let's start with the actual data. In January, existing home sales fell 8.4% month over month. And so that's not a minor seasonal dip. That's a sharp pullback, and it was much larger than economists were expecting. On a year-over-year basis, sales were down about 4.4% compared to the previous January. So this isn't just December to January noise. Activity is still weaker than it was a year ago. And sales are now running at an annualized pace of just over 4 million homes, which puts us near the slowest levels we've seen since late 2023. And that's a significant slowdown. So here's where it starts to get interesting. The median home price came in at about $397,000, which is still above what it was compared to a year ago. So let's pause on that dynamic and talk about that. Sales are falling sharply, but prices are still increasing. That tells you something important. We are not in a forced selling environment. We are not seeing widespread price cuts across the board. Instead, what we're seeing is lower transaction volume. And in housing cycles, volume usually shifts before prices do. When a market starts to cool, the first thing that drops isn't prices, it's activity. There's fewer buyers, there's fewer closings, and there's more hesitation. That's exactly what January looked like. But now the big question is whether this is just a rough winter month or whether the falling volume is the early signal that the broader housing cycle is starting to shift. And as I mentioned, interest rates aren't falling. So let's talk about why interest rates aren't translating into more demand. So here's the part that makes this data confusing at a quick glance. Mortgage rates have come down from their recent highs. They're not back at 3%, but compared to where we were a few months ago, borrowing costs have gotten a little bit cheaper. You see, normally when rates fall, you see buyers react pretty quickly. Housing is very rate sensitive, but this time, the reaction just isn't showing up in the sales numbers. So now you're going to ask, why is that? So first, rates may be lower, but they're still historically high relative to what buyers are used to. Going from 7.5% to the mid 6% range is some relief, but compared to the 3 to 4% mortgages people locked in during COVID, it's still expensive. And for many buyers, that shift permanently changed the math for them. So even if the mortgage payments improve slightly, they're still facing monthly costs that are hundreds or sometimes thousands of dollars higher than they would have been a few years ago. And so that 1% rate drop to 6.5% just isn't enough to make up for the 4% gap that had been created. Second, the lock-in effect hasn't gone away. Millions of homeowners are still sitting on mortgages below 4%. If they sell, they have to give those rates up. So even though inventory has come up a little bit, it's still nowhere near pre-pandemic norms. Lower rates can boost demand, but if supply is still tight, you don't get a surge in transactions, You just get a slightly more competitive version of a constrained market. And then we talk about the psychological piece. Housing decisions aren't made in isolation. If buyers feel uncertain about the economy, the labor market, or whether rates will fall further, they're going to tend to wait. I know in my case, I would be waiting too. And right now, this market feels like that's what's happening. People are cautious. They're not panicked, they're not euphoric, they're just being cautious. Affordability has improved on paper, but confidence hasn't improved. And when confidence is behind affordability, demand stays behind too. And that's usually what happens in the later stages of a housing cycle. When rate relief alone isn't enough to reignite momentum, the real question becomes, if lower rates can't get buyers moving right now, then what will? So let's talk about where we could be in that housing cycle. So in the bigger picture, if you zoom out, housing cycles don't usually turn with a crash headline. They turn quietly. In fact, sales volume weakens first. Then listings will start to sit on the market longer, and then price growth begins to slow. Only later, if that slowdown persists, do prices start to adjust. Right now, it seems pretty clear that we may be in that first stage. Volume is soft. An 8.4% monthly drop isn't noise, it's a signal, especially when it comes on top of already subdued activity levels. But we're not seeing widespread price decline nationally. That's an important piece. In a true downturn phase, you'd expect to see rising inventory surging past demand, sellers cutting prices aggressively, and median prices falling year over year. That part isn't happening yet. And instead, what we're seeing looks more like a late cycle plateau. The surge phase of the pandemic is long gone. The correction phase from rate spikes happened in 2022 and 2023. But since then, the market has been stuck in this constrained, low volume equilibrium. There's low supply, moderate demand, high prices, and low transaction volume. That's not an expansion, and it's not a contraction either. It's simply stagnation. And stagnation is usually not good for the housing market. Markets don't just stay in equilibriums forever. They either reaccelerate if rates fall meaningfully, or slow further if demand continues to weaken. That's why the spring season matters so much. Spring is when housing shows its true direction. If sales rebound sharply in March and April, then it'll be clear that January was just a one-off. But if volume stays weak into the peak season, then this January report won't look seasonal anymore. It'll look like the early stage of a broader slowdown. And historically, when housing volume declines persist for several months before spring, it often precedes slower price growth later in the year. It doesn't necessarily mean there's going to be a crash. In fact, I would pretty much rule out there being a crash at all. But there definitely could be a shift. Right now, we're just at the beginning of seeing whether that happens or not. So what should you watch next if you're waiting for the housing market to dip further? So if January gave us any indication as to what could be coming, what would confirm that that's going to happen? Well, there's 4 things that I'll be watching closely over the next 30, 60, and 90 days. First, we're going to be watching spring sales momentum. Spring is everything in housing. That's when things really start to pick up on a regular basis. March, April, and May are when buyers start to show up in droves. That's when you'll see if the market is really coming back, is going to be strong, or is going to weaken for that year. And if sales rebound sharply in the next couple of reports, then January is just going to be something that just happened once and that was it. Move on from there. But if we move into the peak season and sales remain weak, especially on a year-over-year basis, that's when this starts to look like a structural slowdown. So spring is going to be the stress test here. The second thing to watch, if listings start to rise meaningfully, not just inching up, that shifts leverage towards buyers. More inventory plus softer demand equals slower price growth. Now, if inventory stays tight, prices can remain sticky even with lower sales. Volume and price can diverge for a while, but not forever. Now, third, rates are still the most powerful lever in housing. If mortgage rates fall meaningfully, say into the low 6% range or below, you could start to see demand react quickly. But if rates stall or move back up, That could reinforce the slowdown we're seeing in sales. The market right now is very rate sensitive. And then finally, we're going to watch price growth. Not just the median price alone, but the pace of appreciation. If year-over-year price growth starts to slow down month after month, that's often a sign that volume weakness is bleeding into pricing power. Housing turns slowly. Volume weakens first, then price growth cools. And that's when, if the slowdown continues, prices will adjust. We're currently in the first phase of that. And that's really the story right now. There's not a panic, not a boom, just a market at an inflection point. So if you take away anything from this video, let's talk about just where we stand. Home sales just fell sharply, not during a rate spike and not during a recession, but during a period when borrowing costs have actually eased. That's not nothing, because when lower rates stop stimulating demand, it usually means something deeper is shifting. Right now, we're not looking at a crash, we're looking at tension. Tension between high prices and cautious buyers, between low inventory and weak transaction volume, and between a market that wants to stabilize and one that might be losing momentum. Housing cycles aren't going to flip overnight because they move slowly. Volume's going to dry up first, then confidence is going to weaken, and that's when the prices will start to cool. And now January may just end up to be just a winter slowdown, or it may be the first crack in what looks like a stable recovery. We won't know until the spring data comes in, but one thing is clear. This market is no longer accelerating like it was. It's starting to figure out where it's going to head. And once the housing market gets settled on a direction it's going to move in, it tends to stay going in that direction for a while. So the next few months aren't just routine reports, they could be a referendum on where 2026 is headed. If you want to understand where the housing cycle is going next, not after it's obvious, but while it's forming, make sure you're following along, because this story isn't over, it's just getting started.